Hey everyone, welcome to Fintech South. Today we are going to be talking about democratizing investing. I'm Dara Albright, Dara Albright Media, and I'm really excited to be here today with two of who I consider to be probably the foremost visionaries when it comes to the democratization of investing, especially in the fintech space. So we have here with us, we have Brian Daly of GROUNDFLOOR. We have Sally Albright of Worthy Financial. We're going to learn a lot about what's happening in the space, all about the landscape now for retail investors, how it's changing. It's exciting times. It's exciting times for everyone. And with that, let's just start with you guys. Maybe Brian, you want to start first. Just you two introduce tell us a little about yourself, your platform, and then we'll just jump right in.
Sure. My name is Brian Daly, co-founder and CEO of GROUNDFLOOR. It's great to be with you guys. I know Dara and Sally well, and it's fun to be with you guys on a panel here at Fintech South. We started GROUNDFLOOR 7.5 years ago with a mission to level the playing field in finance. And GROUNDFLOOR today finances, last year, over $100 million worth of real estate investment loans. And we allow the retail investor to participate in those loans at a minimum investment of just $10. You can earn returns about 10% on average, get your money back in about 8 to 9 months. And you do that without locking your capital up in a fund. So we feel like GROUNDFLOOR is an example of things to come, things that are happening. And that's, I think, what we're talking about today.
Awesome. Sal?
Yeah, let me clarify, even though she introduced me as Sally Albright. I love Dara, but we're not related. It's actually Sally Outlaw. Yeah, crack me up. Crack me up. I know we're close, Dara.
Sally, too much.
No worries. There's not a family I'd rather be part of than yours, so we're good. Anyway, so I'm with worthybonds.com, and much like Brian, we're a fintech company that's leveling the playing field for retail investors. What we do is we have basically used updated securities laws under Regulation A+, and we use those laws to create a proprietary bond. Really, it's a $10, 5% interest earning bond, and we can sell it to everybody. We can sell to retail investors. And we're really doing two things with that bond. We're helping people build a nest egg because they can get 5% return on their money. There's no fees. It's liquid. And then we use those proceeds to lend out into secured loans for growing American companies. So you're really getting that social impact along with your financial impact. So that's what we're up to.
That's great. So Brian, let's start with you because we've seen a lot of activity now with respect to public market innovation, especially, in the equity public markets, especially with robo-advisors, the likes of Robinhood and a lot of other names in that space. So there seems to be a very strong demand, and even for, even the equity crowdfunding space. Could you contrast a little bit of what's happening with respect to public market innovation, equity innovation, with what's happening in the private debt space?
Sure. So the reason we picked a debt security is that fills a huge hole in investors' portfolio for a low volatility, high certainty. It's not sexy. It's not Bitcoin. It's not going to go to the moon. But it is going to deliver 8, 10, 12% to you every year. Now, if you step back and look at something like Robinhood, that is bringing first-time investors into options trading, there's a lot of activity out there to re-intermediate financial markets. And that's for good reason, because the up-and-coming generations, and even Gen X like me, we've seen how financial institutions aren't necessarily deserving of our trust. And people are looking for new intermediaries. Now, what's happened is you've seen millions of people pile into these public market sort of intermediaries, and that's a great thing in some ways. What's tough about it is that people are taking on risk that maybe they're not aware that they're taking on. At some point, the market does deliver the downside to those risks. And so I think what's exciting for the retail investor is right behind that wave of public market intermediation, we're seeing a crop of new entrants who are offering private market securities. Now, private market securities is where, for a long time, a lot of the alpha has been. right? A lot of the excess return for lower risk, right? The question is, how much risk are you taking and how much return are you getting for it? And I think that's, when we started Ground Floor, that was our intent. Our intent was to open up these private markets. It's hard to do, right? It's hard to find these private market opportunities. It's even harder to go to the SEC as we did and qualify an offering that allows you to invest directly in them as though you were a hedge fund manager. But with something like Ground Floor, you get to do what hedge fund managers do. Even if you only have $1,000 to invest, you can be in 100 loans with our $10 minimum. And that's the kind of thing that I think is coming. I think there's going to be there already is. I mean, we're seeing record demand. I mean, we're up 33% quarter over quarter, the last 2 quarters in a row. We're hitting records through the pandemic as people realize, wow, public markets are choppy. Some people feel public markets are rigged against the little guy. Private markets are the next place for people to go. And we're already starting to see that kind of adoption.
And it's interesting, and Sally, maybe you could weigh in on this a little bit too. We saw, I guess, the attraction to the equity markets and the higher risk type of products on the fintech platforms, really kind of luring in the more of the risk takers. But now, do you kind of envision more of a gravitation towards more of the debt-based platforms that offer a little bit less volatility, less risk, that type of product?
Yeah, we've certainly seen it. I concur with what Brian said. I mean, we've sold $100 million worth of our bonds, and it's only increased during the pandemic. I think because Main Street's not tied to Wall Street. There's this disconnect. And even though we're suffering on Main Street, the Wall Street's going up and down, and there's all kinds of volatility, and it's up one day and then down the next with political news or a vaccine. So I think if people want consistent returns, it's nice to have a debt product like ours, or like Brian's or mine or other people in this space that's not tied to the public markets. And I don't know if Brian may not have mentioned this, but we're under what's called Regulation A+. And Reg A, most of Reg A deals, whether it's equity or debt like ours, they're not tied to the public market. So you don't have to worry about that volatility. So we've seen tremendous growth. I mean, as Brian mentioned, he's seen tremendous growth. And I think it's also, there's 2 other elements here. One is the impact, right? People want to be able to do things with their money that matters. And, by investing in someone like Brian's product or my product or other Reg A products, you're really helping American businesses grow, or you're helping, community real estate in his case. So I think that impact piece and the social piece is also important here about why, some of these people are moving away from the public markets. I don't think it's just the volatility or the seeking of consistent returns. I think it's, people wanting to, do something that matters with their money.
Right. And I also, talking about, just mitigating risk in a retail investor's portfolio. I mean, they can't be all equity. They can't even be all bonds. It can't be one asset class, millennials. You can't be all Bitcoin. You need to really have, be very properly diversified. And I think the fact that you guys offer $10 minimums, really changes the game for retail investors, because that gives them not only an opportunity to diversify, not only among, amongst different asset classes, but within specific various asset classes. So I think that really is a game changer. And if you look at where, rates are now, I mean, people are getting less than 1%, in a bank account. I mean, it's absurd. Even treasuries. So, I mean, they people looking for yield. They need yield. So they need to, and especially when you look at the retirement crisis that's looming in this country, we need to get this. We need to get this out there. It's interesting. We're talking a lot about the democratization and how this is impacting retail investors. Maybe you could talk a little bit about what steps you both are taking to really empower retail and investors, and what you're doing to maybe impede some of the institutional dominance that we've seen in the markets, over the last couple of decades.
Yeah, I mean, our analysis when we started the company was that not only were retail investors not getting their fair share of the pie, retail investors weren't even being served the same thing. And so we started with a motivation. I mean, I've been an individual investor since I was age 15, and investing in mutual funds. I had to go to the library to learn what that was. But that's what motivated us. But the more we looked into it, we started to learn as we did customer development in different capital markets to figure out what kind of asset were we going to turn into a security that would be the next great mass market investment product. We started to realize that institutional capital, when it dominates a capital marketplace, actually creates important distortions in those capital markets. And because we've sourced our capital from the retail investor, and last year it was 80% of our capital came from the retail investor, 20% came from institutions. We realized that we could actually create features for the user of the capital that were better for the user of the capital, that were healthier for the capital market. And the true test of that is when COVID-19 hit and the capital markets shut down. Now, I say the capital markets shut down, the institutional capital markets shut down. It was the hedge funds and the banks and the private equity firms who had leverage on their balance sheet and who had redemption requests that were being pulled from them and had to pull out. So precisely when real estate entrepreneurs, in our case, needed the capital, that's when the big money steps out. And he who has the gold makes the rules. Now, when you have a retail investor marketplace, and you're never going to have a 100% retail market for any particular capital market, right? There has to be a balance in the aggregate. But we decided at Ground Floor, this year we went 100% retail. When we saw the institutions back away, we saw that as validation of our thesis about capital markets. And now we've pivoted and said, nope, we're going to end the institutional capital experiment. We're going 100% retail. We know our products are better. We know that we're more durable. Our retail investment capital didn't go away. In fact, it grew throughout the pandemic. So I think that's a good example of how really in any capital market, in every capital market, there needs to be a balance. And in the markets that we're addressing, there's just a bunch of institutions and rich people who are profiting. I mean, every platform that sounds like Ground Floor, by the way, in real estate, look at the footer of their website. It's actually only open to accredited investors, right? The Pure Streets of the world, or all these guys, or if you look at something like Fundrise, it's just a fund, right? They're taking your money and they're deploying it. What's unique about what we're doing is we are really going to the iron of retail capital and saying the retail investor gets the same control, the same advantages that the institutional investor gets. That's not only great for the retail investor, it's great for the user of the capital on the other side and the marketplace as a whole. So, we feel as convicted about that after 7.5 years as we've ever been.
It's interesting that you say that because it's true. People don't realize it, but having these, big, expansive capital bases, that with all these different investors, is actually even better for the issuer. Because I always use the example. Once worked on a trading desk, and you get one order from an institution like a Fidelity to come in and sell its position of a small cap company, that could really kill the stock, or hurt it tremendously. But you have Sally Outlaw coming in and telling her
that's Sally Albright, Dara, not Outlaw.
Right. Selling her 100 shares to pay for a root canal doesn't impact the stock price at all. So people don't realize just really what the advantages are overall. Diversifying within within someone's investor portfolio, but also just for the issuer. Maybe Sally, you could weigh in on that too. What is Worthy doing as well to empower retail investors, and impede sort of this institutional dominance that we've been seeing?
Very easy answer to that. We don't have any institutional investors, much like Brian. We're 100% retail. That's our mission, but it's also a good business model for the reasons you both pointed out. So in our case, we actually even lowered recently our maximum amount of bonds you could buy. It used to be $100,000. We lowered that to $50,000. Our average purchase is still around $2,000, but there were people who would come in and try to buy these big chunks. the other thing, what we didn't mention with Reg A is there's a $50 million maximum you can sell per entity per year. So, it is limited in terms of how many securities you can sell under this regulatory framework. So in order to make sure we had enough bonds for the retail investor, we lowered our maximum purchase amount as well. So, we're 100% focused on retail investors. Those are the people we want to help. That's the whole mission of Worthy.
And Sally, do you want to weigh in a little bit? Because I think your platform, I'm a huge fan of just the whole, these savings aspect of it, and how you're using really fintech to really help small investors, especially in these tough times, build their nest eggs when it's getting more and more difficult, and the retirement system is getting a lot more challenging. Maybe you could talk a little bit about that too.
So I guess you're talking about the features where we have the roundups and yeah. I mean, essentially, it's hard to change behavior. People aren't going to change their savings behavior and suddenly start tucking their money away. That's been proven. So we built in, I guess you could say we're reg tech because, Brian as well, because we had to use these new regulatory frameworks to create our product. But on the other side, we have the fintech where we're digitizing these assets, making it easy to sell. And in our case, yes, we have these features where we can round up your spare change. That's becoming, more and more common, I think, with some of these apps where, every time you shop, we round up your, purchase to the next whole dollar. And when that spare change reaches our $10 bond purchase threshold, it buys a bond, for your portfolio. You can set a recurring investment. So, every time you get a paycheck, you can set it and forget it. You're taking out $10 or $100, $1,000, what have you, and buying the bond. So we're trying to bring tools to make it easier for people to tuck that nest egg away. And I think, the hope is if you can use those automated investment tools and you can start growing your portfolio, then you might get more excited about then making manual investments and looking elsewhere and, going on Brian's platform, going to other people's platform. We're just, trying to do what we can to help people painlessly save.
So what do you guys think, just in really sort of getting this message out there to the, what do you feel is the best way to really reach the masses? Because this is really the future of investing. It's here, it's now, but we're still at a place where people are, there's that learning curve, and people are really just starting to learn about. So what do you think is the best answer to that for really kind of getting this out to the masses? Because we need it now.
I mean, we've always joked that ground floor is an unknown product in an unknown category from an unknown company. Whenever we've, when I hired our SVP of marketing, who's now our COO, Rhonda Hills, that was my pitch. I'm like, hey, here, this is going to be great. It's a big marketing challenge. But in all seriousness, financial literacy in the United States is, it's a challenge, right? I mean, people have to take matters into their own hands for their financial future. We don't have, 20 and 30-year careers at an employer with a pension anymore. And, we take that serious. I mean, for a startup at our scale, we're a growth stage startup. Last year we exited about an $8.4 million run rate in revenue. We have some resources now that we can put into user education. We think the number one thing that people need to see is how much better this is as a proposition for them on the merits, right? It's in our case, it's a shorter term hold, and I love the liquidity of Sally's product. I think it's really great to have that kind of liquidity so that you can tap into it when you need the money.
Right.
But in our product, the hold period is a little longer, but it's certainly not as long as a fund or a REIT or private investment that you might make. But to see that you get this short-term hold period or turn time, you get these extraordinarily high yields because of what private markets are, and because of the value that's there and the value that we're unlocking, right? That's why Sally can offer 5%, because she's off in these private markets buying these things that are difficult to access, and there's a lot of alpha there, right? That's why she can deliver 5%. That's why we can deliver 10%, right, on a longer hold period with a different risk profile. So I think educating people about what that value is, and what we've noticed, and I think Sally has said the same thing when we've talked about it, people start off dabbling to see if this is real and are they going to get their money back and what is it like? And then they realize, oh my God, it really is real. I'm going to put more of my assets. We've seen people, move a chunk of their IRAs into GROUNDFLOOR, which is great. We have an IRA product. And I think that's what has to happen. But it's almost like it's a technology adoption curve, right? You had the visionaries and the early adopters, and now we're getting into the early majority. And that, to speed up that process, frankly, we need growth capital, right? Which is why we're on Seed Invest raising our Series B right now, which you can find at seedinvest/GROUNDFLOOR. We need growth capital in order to afford sort of the talent and the people to build up that user education function and to help us afford the acquisition of new investors that take some time to pay off, right? It takes some time to recover the acquisition cost of those. And so that's just a natural process that we're all going to go through as startups. I think in both of our cases, it's going really well because we have good products, right? And we're on the right side of history, right? I mean, at the end of the day, we're on the right side of history, and that's where you want to be with a startup.
Well, that's actually a great segue into the final question, because I know we just have a few minutes left. And I mean, 2020 has been a unique year, let's just say, to say the least. When historians look back on this year, how do you think they're going to view how 2020 impacted this space in particular, fintech, micro investing, all of this asset class innovation, investment democratization? What will be 2020's impact?
Well, let's hope none of us have to look back on 2020. So, but I guess if we have to,
well, we look back to see how far you've come. So.
Yeah, I guess that's okay. That's okay. I just don't want to relive this year again. No, but there's been. I was in a session yesterday, and the comment was made. There's a 280% increase in online investing, over the last 9 months of this year. So I think everything's accelerated under COVID. Virtual events have accelerated. Telemedicine has accelerated, and I don't see any reason why. This won't continue to happen in our space. There's been a tremendous, movement to online finance and to impact investing, like many of these private market investments we're talking about. So I just think it's going to continue to grow, and I think with the proper education and getting the word out there, it's just more and more people are going to gravitate to investing in these kinds of products.
And maybe because of the virtual nature of even these events reaches more people. So such as like Fintech South and being out there, being able to have more people. What do you think, Brian?
Oh, I just think these dislocations always wake people up. And when people wake up, they pop their head above the turret and they realize the world is different from what they thought it was before. In 2008, 2010, people became very angry with Wall Street and the banks. And that created a wave of, fintech innovation, right? And I think we're going to look back at this period and see the same thing. We're going to see the same thing. It's going to change consumer behavior. It's going to change our framework. And that acceleration doesn't surprise me at all.
Yeah, I think that's, I think we have just a couple of seconds left. It's a wrap up. Okay. So, I just want to say thank you guys so much. This has been really, really educational, really enlightening. I love what you guys are doing. I'm a huge fan, and just, keep it up. I can't wait to see what historians are going to look back and just to this year and what they're going to say just about Worthy and GROUNDFLOOR, because you guys are just doing such incredible work. So thank you. And thank you, Fintech South, a really terrific event.
Agreed. Thanks very much.
Thanks for having us.
Take care.